Good morning, everybody. Can you guys hear me okay? I'm going to try to walk around a little bit. I don't like standing right up here. So you can read all this about me. I'm not going to talk too much about that. I am based out of our Hagerstown office, so I do work more with our Maryland nonprofits, but I do also work with some clients in Pennsylvania, West Virginia, and Virginia as well. I have this broken down into 3 segments this morning. The first, identifying key performance indicators or KPIs, which we will see will be a little bit different depending on the industry that you're in. As we know, not all nonprofits are created equally. Beyond that, we're going to look at calculating some key or fundamental financial ratios that, regardless of industry, could still be very useful to your organizations. And then how to engage your board, not just your board, but also your management or employees that are not the financially minded folks in your organizations through trend analysis and graphs, because ultimately we want you to be able to make sound financial decisions regardless of your finance level of knowledge. So identifying KPIs. I put annual revenues at the top because you got to bring in money to pay the bills, right? But to the point on sustainability, I'll skip down a little bit here. Days cash on hand. How many of you found during the pandemic that you were going through your cash reserves a lot quicker because those revenues weren't coming in? Did that happen with a lot of your organizations? I know a lot of my clients it did. And so, again, being able to look beyond what you're bringing in annually and looking at that rainy day reserve of how much cash do I have, or just liquid and available resources in general to pay those bills in a situation. It doesn't have to be a pandemic. I think that was the biggest issue that we found, is that was such a major problem. But in any situation where those revenues just aren't coming in at the level that they used to. Fundraising return on investments. How many of your organizations rely on some type of annual fundraiser, whether it's a mailer, a special event, some type of fundraising revenue? Show of hands, probably a fair number of you, right? Is it worth the money that you're putting in to run the fundraiser? And I don't just mean the direct costs like to rent a venue and to staff the event or to put out a mailer, but the indirect costs, your personnel, right? Because you probably have staff or board members or other volunteers that are working to run those fundraisers. So being able to calculate a return on investment to see, is it worth the money and the resources that I'm putting in for this event to happen or for this fundraiser? Donor retention. How many of you rely on donors year after year after year? It's real nice when we get those bequests or those one-off really large numbers, but all in all, having donors that come back year after year after year are another key to sustainability for a nonprofit. Percentage of program expenses. Anyone in here writing grants? I hope. I'm thinking probably. How many of you have had to answer what percentage of your expenses are program specific? Does that ring a bell? Yeah, so we talk about it on our financials. We show it in the 990, but your donors want to know that too. And a lot of grantors, which is why they ask the question, because they want to know how much of every dollar coming into this organization is actually supporting the mission of the organization versus how much is going to G&A overhead. Days cash on hand we talked about, and we'll talk about that here a little bit more as well. Operating margins. So how many of your organizations rely very heavily on investment performance to figure out what your bottom line looks like year after year? Anyone? Maybe not? Couple? So the operating margins are going to look solely at your operating revenues, exclusive of things like investments and maybe some derivatives, which I'm guessing only a few organizations in here have, but determining how well you're actually operating based on, again, what you're doing day to day. And then lastly, the budget to actual, which I think is pretty self-explanatory. So these are some, not meant to be all-inclusive, but some ways in which you can measure financial success. We're going to talk about a little bit, a few of these in more detail. So some industry considerations. How many folks work for organizations where you're providing some type of good or service, where the majority of your revenues are program generated as opposed to contributions? Okay. And then presumably the rest of your organizations, you're relying a lot on maybe those fundraisers and contributions. So some of the industries that we work with, we have a lot of healthcare clients, human services. Some ways that you can measure financial success beyond the dollars is looking at your patient encounters, number of clients served, number of performances if you're with a theater or an orchestra. How many clients are you serving? You generally can take those numbers and put a dollar figure on there, but those numbers also help you to measure financial success. Because if you're not serving as many patients or as many clients, what's happening to your revenues? They're probably going down. Do we have any foundations in here? Couple? Okay. So, one of your measures of financial success is probably in pledge fulfillment. And again, looking at that fundraising ROI, because how many times have we gotten pledges in and then maybe it's from an employee who then left and didn't fulfill that pledge, or a board member who left and didn't fulfill the pledge? And it doesn't have to be somebody internally. I'm just using these as examples. But these are critical measures of the financial success of your organization is how many of your pledges are actually being fulfilled percentage wise. And then again, that fundraising ROI. And then I don't know if we have any like trade associations in here, but some other types of key measurements for financial success for those types of organizations could be things like your membership retention as well as membership growth. We talked a little bit about this, but operations versus reliance on investments. I do work with a fair number of clients that having solid investment performance tends to drive that bottom line. And so, in a year like we're coming out of, or a couple of years where there's been a lot of market fluctuations and not positive fluctuations on the stock market side, that has been a detriment to some of my clients' bottom lines because of that. So, being able to evaluate your operations, again, those operating margins outside of investments. All right, so now that we've had just a couple of considerations of what some KPIs could be for your organizations, let's talk a little bit about calculating fundamental financial ratios. First two slides I have here are liquidity ratios, and looking at the sustainability comment, this gets back to how well can your organization pay the bills. So days cash on hand, and you have these here in your slides so that you can refer back to them. But you're basically taking a daily expense rate net of any non-cash expenses like depreciation and amortization and dividing that into your unrestricted cash and liquid investments. Now, I know when you hear cash, you're like, why are investments included in there? It is possible that if you have investments that are, as I say here, liquid, those can be factored into days cash on hand, because if those investments are easily converted to cash, you can include those. We're going to take it a step further. For those of you that have audited or reviewed financials or even compilation that have disclosures, you'll know that a couple years ago we had to start adding this new disclosure called liquid and available resources. We're going to take the days cash on hand and expand that a little bit further to include current assets, like your current accounts receivable expected to be collected within a year. If you rely on grant funding or contributions, that can be your grants or pledges to be receivable within 1 year. And that ratio then is ultimately going to be a little bit better, right? Because you're not just taking the cash, but what you actually expect to convert to cash within a year. And then again, dividing that by your same denominator to determine what your rainy day slush fund is. So in the extent, or in the instance that revenues stop coming in, how much money do we have to pay the bills? Again, some other liquidity ratios then, days in accounts receivable, and a related ratio would be the AR turnover. So how quickly are you collecting those? Anyone in here struggle to get grant funding timely? I know I work with a couple of organizations that sometimes can be 6 months more behind. That's going to play or wreak havoc on on your liquidity ratios if you're not collecting them. Same thing if you have patient accounts receivable. Again, for any of your organizations that rely on program services, whether you're collecting money from the patient themselves or collecting money from the state or the federal level, again, having a good ratio for your days in accounts receivable, a low number, is going to be a measure of financial success. And then the last liquidity ratio I have up here is the current ratio. It's pretty well known. Current assets divided by current liabilities, and a solid ratio there is a 1-to-1. So that basically means that for every dollar of current liabilities that you have to be paid within a year, you at least have the exact amount of current assets to cover those. Okay, so operating ratios. So beyond having liquidity and having like the balance sheet type accounts to pay bills, now we want to look at operations and profitability and how the money you're bringing in generates hopefully financial success for your organization. So looking at the operating margin, This is going to be your income or loss from operations. So again, excluding anything that is not part of operations. I use investments because that tends to be the most common, even for smaller nonprofits. But again, if you have swaps and derivatives, things like that, there could be other non-operating components to that as well, divided again by just the total operating revenues. So that gives you a good idea of operationally how well you're doing. We talked about program efficiency, but I'm going to again highlight it here. Total program expenses as a percentage of total expenses. Typically, we like to see about 70 to 75%. Of course, if it's higher, that's great because that means that more 70, 75 cents or more of every dollar is going directly back to the organization. And that tends to be a pretty solid benchmark for a lot of grants as well, looking at how much money is being used directly to the organization's mission. So fundraising efficiency. You can look at fundraising costs as a percentage of total expenses, and that's fine. But what I'm doing here is taking it as a percentage of total contribution revenue. Again, this helps to determine if the money that you're spending on raising funds is actually being used for a worthwhile cause. Now, that's not to say that if you're generating fundraising expenses or if you're using expenses for fundraising that maybe do not contribute great amounts of revenue that you should stop doing it, but it is at least worth a conversation as to why are we spending money to do an event? Why are we spending money to put out an annual mailer? I know Krista talked earlier about working with some fire and rescue companies. I have seen trends many, many years of the subscription fund money going down. So having a conversation of, is it worthwhile to continue spending the money to do those annual mailers? Now, maybe it is, maybe it isn't. Those are obviously conversations for your individual organizations. But similarly for events, I think, again, the pandemic really raised some questions for organizations that would do annual events because it's an event that they've done for years and years, and maybe the public just knows that event. But if you look at the cost to put it on, if it's not bringing in the money that you think that it is, that what you're getting from it, maybe it's not worthwhile to continue doing that. And then last operating ratio here, return on assets, and that's just a function of taking your net income divided by total assets to say how well are you utilizing the assets that your organization owns in the operations of your organization. And then the last couple of ratios that I have here are capital structure ratios. If you don't have debt, these probably aren't going to be as relevant for you. But for those that do have some level of debt, the first one here is your debt service coverage ratio. So keep in mind that this is more kind of a standard calculation. Individual banks might tweak that a little bit, so it might be slightly different depending on your bank. But in the grand scheme of things, all in all, your debt service coverage ratio is going to take net operating income divided by your annual debt obligation. And that's going to include both principal and interest. So whatever your current portion of your long-term debt is for the next year, plus the annual interest, all of those combined as the denominator for that. And then lastly, total debt to net assets. So in the for-profit, this is similar to debt to equity, and it's looking at leverage. So how well do you leverage the assets of your organization? Are they financed by a third party in the form of debt, or are you able to finance internally through increases in your net assets, which we get year after year of having income coming back into those net assets? And then the last section here, I want to talk about engaging your board through trend analysis and graphs. And I do want to make the caveat that while the numbers in here are an example from an organization that I know, it is not a client, but it is an organization that I know well. It's not meant for us to analyze the actual results of that entity, but rather just to provide some sample graphs, some sample pictorial representations of finances. And what I found is for organizations where I serve on boards or committees, this has really helped those non-finance folks on the board to be able to better make decisions when we're not just going through line item by line item on the financial statements. So a couple of samples here. This is a net income trend analysis, and you can just see I don't even have the actual years. I just have 6 years here. But you can see in year 3 that that particular year was a really solid year for the organization. In this case, there was a one-time bequest that came in, and it was also a really good year for investments. And you can see there that really drove the net income for the year, compared to several other years where bottom lines in some cases were net losses, and even back in year one, more a smaller net income, because the organization cannot sustainably rely on those really, really large bequests or one-time contributions and or solid investment performance. So you can see here again visually, it kind of helps to prove the point that maybe just looking at the financials month to month would not get across. Fundraising ROI trends, I think I've talked about this a good bit, but you can see here on a monthly basis for the past 4 years what the return on the investment for different fundraisers have been. Now, again, depending on the timing of when fundraisers occur, that's going to throw some changes into the month to month activity, but you can see here where the months where we were getting the best return on our investment pretty consistently, at least in 2023. This is actually a really good example of how we analyzed prior results, found ways to reduce our fundraising expenses, and then you can see from October through January to February of 23, even though the trend line is down, you can see in October how that really shot up compared to prior years because we were able to make decisions to get a better return on the investment for our fundraisers. And then lastly, investment trends. This is a really good analysis if you have organizations that have investments with multiple custodians. And we use this as a way, you can see we started it back in December of 2019, and this actually came out during the pandemic, because we wanted to see, with all the market fluctuations caused by the pandemic, how were both custodians performing? And it was a way for us to help keep them accountable as there were changes in the marketplace. How did one investment portfolio respond to the other when they both had the same policy statement, basically telling them how to invest the funds? So all things considered equally, other than there's a clear difference in the amount of overall funds invested with each, how did how did each investment advisor perform compared to the other? And it helps us to make decisions about whether we want to keep more money with one or transfer funds to another. Thank you.